Two massive institutions control more capital than the gross domestic product of almost every nation on Earth. Vanguard and BlackRock. For decades, they have been locked in a silent, brutal price war, cutting fees down to absolute zero just to win a single asset class, the S&P 500. But for you, the beginner, this war creates a critical question. Where exactly should you look? Choosing the wrong vehicle to track the world's most reliable index doesn't just cost you pocket change. Over a lifetime of investing, a microscopic difference in structural execution can drain tens of thousands of dollars from your compounding machine. Today, we put Vanguard and BlackRock head-to-head to find the absolute best S&P 500 ETF for your capital. This is day 6 of our wealth sequence. We are moving from general investment theory into raw, practical deployment. We will analyze tickers, structural designs, and execution mechanics. Before we reveal the winner of this financial titan clash, hit subscribe, turn on notifications, and comment below. Vanguard or BlackRock? Let's dissect the machinery. To understand why this choice is so critical, we must look at what these ETFs are actually holding. The Standard & Poor's 500 is not a random collection of stocks. It is a market capitalization weighted index of the 500 most dominant, profitable corporations in Western civilization. It is the core engine of global economic growth. Because it is weighted by market cap, your money is automatically directed to where it is most productive. The larger and more valuable a company becomes, the larger your ownership stake in it. You are structurally guaranteed to have your heaviest bets placed on the absolute winners of the corporate landscape, week after week. In one corner stands Vanguard, founded by John Bogle in 1975. Bogle didn't create Vanguard to make Wall Street rich. He created it to destroy Wall Street's excessive margins. He designed a corporate structure that is entirely unique in the financial ecosystem, one that changes everything for retail investors. Vanguard is not owned by outside public shareholders or private billionaires. Vanguard is owned by its own funds, which means it is owned directly by its investors, including you. When Vanguard makes a profit, it doesn't hand it to Wall Street middlemen. It automatically lowers the cost of running its funds, passing the savings straight back to you. In the opposite corner stands BlackRock, the undisputed king of absolute scale, led by Larry Fink. Founded in 1988, BlackRock grew at an unprecedented velocity to become the largest asset manager on the planet, commanding over $10 trillion in capital. Their ETF weapon of choice is the legendary iShares lineup. This creates a fascinating ideological divide. On one hand, you have Vanguard, built as a member-owned nonprofit utility designed for pure consumer protection. On the other hand, you have BlackRock, a publicly traded corporate powerhouse listed on the New York Stock Exchange, driven by relentless technological optimization. Let's look at the actual tools. Vanguard's flagship S&P 500 ETF is traded under the ticker symbol VOO. It is the default recommendation of almost every independent personal finance expert on Earth. It has a single mission: to perfectly replicate the performance of the S&P 500 while charging you next to nothing. BlackRock's direct answer to VOO is traded under the ticker symbol IVV, the iShares Core S&P 500 ETF. For years, these two vehicles have tracked each other with such incredible precision that their performance charts look like a single line. To find a true winner, we must look deeper into the microscopic financial metrics. The first metric is the expense ratio, the annual management fee deducted from your total investment. In 2026, both VOO and IVV are locked in a dead heat, charging an ultra-low fee of just 0.03%. This means for every $10,000 you invest, you only pay a tiny $3 a year to hold the asset. To realize how incredible a 0.03% fee is, look at the older generation of investments. Many traditional bank mutual funds still charge 1.5% or higher. That difference sounds small, but over an investing lifetime, that fee gap means losing hundreds of thousands of dollars to corporate commissions. There is a third competitor that beginners often buy by mistake: SPY, the State Street SPDR S&P 500 ETF. SPY was the first ETF ever created, and it remains the most traded fund in the world. But it has a hidden flaw for long-term buy and hold investors. Its expense ratio is 0.09%, 3 times more expensive than VOO or IVV. Why does anyone buy SPY if it is 3 times more expensive? Because of liquidity. Massive institutional hedge funds and day traders move billions of dollars every minute. They need the extreme volume of SPY to enter and exit trades in milliseconds. But for a beginner building long-term wealth, buying SPY is simply wasting capital on unnecessary overhead. Eliminating SPY leaves us with the ultimate choice: VOO versus IVV. Since their costs are identical, we must evaluate their tracking error. Tracking error measures how perfectly the ETF manager copies the underlying index. A bad manager leaves money uninvested, causing the fund to lag behind the actual S&P 500 returns. BlackRock uses a hyper-advanced proprietary software ecosystem called Aladdin. Aladdin monitors risk and executes automated trades across trillions of dollars with military precision. Because of this extreme technological backbone, IVV's tracking efficiency is practically perfect, capturing every single fraction of a percent the index produces. Vanguard matches this precision through sheer scale and experience. Because VOO manages hundreds of billions of dollars, they can execute massive internal block trades without moving market prices. Both managers are so efficient that the tracking difference between VOO and IVV is completely negligible to the human eye. Since fees and tracking performance are a tie, the true deciding factor comes down to an obscure legal distinction that 99% of investors completely overlook. It lies within the regulatory framework of how these specific funds are legally structured under security laws. VOO is organized as a standalone share class of a broader Vanguard mutual fund structure, while IVV is built as a pure, independent unit investment trust. In the next block, we will dismantle exactly what this corporate engineering means for your dividends, your security, and your ultimate choice. When you look closely at how VOO and IVV handle cash, a subtle operational variance emerges. The companies inside the S&P 500 do not pay dividends all at the same time. They distribute cash throughout the quarter. How an ETF manager hoards, manages, and deploys this incoming cash before paying it out to you creates a silent friction. Because VOO is structurally integrated into Vanguard's broader multi-billion-dollar fund ecosystem, it has a massive operational advantage. Vanguard can immediately take the incoming dividend cash from companies like Apple and reinvest it transiently into the market or stock futures. This minimizes cash drag, ensuring every cent is working continuously. BlackRock's IVV, operating under a different legal framework, faces strict regulatory limits on how it handles cash between distribution dates. It cannot easily reinvest interim cash back into the index structure. It must hold a portion of this cash in non-interest-bearing accounts, creating a microscopic lag known as cash drag during roaring bull markets. To counteract cash drag and drive their fees down to zero, both Vanguard and BlackRock engage in a highly lucrative, invisible practice: securities lending. They take the trillions of dollars of stocks sitting quietly in their vaults and temporarily lend them out to institutional short sellers and hedge funds. In exchange for borrowing these shares, hedge funds must pay a premium fee and post over 100% collateral in cash or government bonds. It is an incredibly safe operation. If the hedge fund collapses, the ETF manager simply takes the collateral and buys the shares back on the open market. Your core investment is never left exposed. The multi-million-dollar question is, who gets to keep the profit generated from lending your shares? This is where the core philosophical difference between Vanguard and BlackRock becomes a tangible reality on your balance sheet. At Vanguard, because there are no private shareholders to feed, 100% of the net profits generated from lending securities is funneled straight back into the fund itself. This extra revenue acts as an internal subsidy, effectively driving the operational cost of VOO even lower than its advertised price. BlackRock, as a publicly traded corporation, operates on a different mandate. They run an incredibly efficient lending program through their proprietary technology, but they keep a predetermined slice of those lending profits to boost their own corporate earnings and reward BlackRock shareholders. The rest is returned to the ETF. Does this split mean BlackRock is robbing you? Absolutely not. Because BlackRock's lending desk is so aggressively optimized by their artificial intelligence systems, their total revenue pool is often larger. Even after taking their corporate cut, the net return passed back into IVV frequently matches Vanguard's execution dollar for dollar. Now let's look at your execution day. When you use your brokerage account to buy an ETF, you need to understand bid-ask spread. This is the invisible spread between what buyers want to pay and what sellers want to accept. For large index funds, this spread represents a hidden transaction cost. Because both VOO and IVV trade millions of shares every single day, their bid-ask spread is a microscopic fraction of a penny. The liquidity is so massive that whether you are investing $100 or $10 million, your market orders will execute instantly without moving the market price by a single hair. However, if you ever plan to advance your financial strategies into the domain of options trading, such as writing covered calls to generate extra yield on your portfolio, the landscape shifts. Here, BlackRock's underlying structure offers a slightly more active ecosystem. Due to BlackRock's deep roots inside sovereign wealth funds and institutional pension plans, their financial products often feature specialized derivatives markets with higher open interest. If options mechanics are in your long-term roadmap, IVV provides a slightly sharper edge in derivative market depth. To truly stress test these giants, we must ask the dark question: what happens during a systemic global financial meltdown? If the parent company faces bankruptcy or legal indictment, what happens to the capital you have spent years accumulating inside their S&P 500 ETFs? The answer provides total peace of mind. Under both Vanguard's mutual structure and BlackRock's trust structure, the underlying stocks of the 500 companies are completely segregated from the corporate balance sheet of the manager. If BlackRock as a corporation goes under, their creditors cannot touch a single share of your ETF. In a worst-case corporate collapse scenario, regulators would simply strip the management contract away from the failing parent company and hand the entire index fund basket to another healthy custodian bank. Your fractional ownership of Apple, Microsoft, and Amazon remains legally intact and completely uninterrupted. The real structural risk for a beginner isn't the collapse of Vanguard or BlackRock. The risk is choosing an ETF from a third-tier, low-volume provider just because they offer a temporary promotional discount. Lower volume ETFs have wide bid-ask spreads and run the risk of sudden liquidation, forcing unexpected tax events on you. This is why wealth architects stick strictly to the undisputed royalty of the index world. By choosing either VOO or IVV, you are hiding behind the largest capital moats ever constructed in human history. You are piggybacking on infrastructure that is literally too big, too regulated, and too systemically critical to fail. Now that we have proven the safety, compared the internal revenue streams, and established that both titans charge the exact same 0.03% fee, we must look at the hidden transactional math. We need to calculate how even a microscopic difference in cash deployment changes your compounding engine over 20 years. The operational differences are subtle, but they are real. In the next block, we will deliver the final comparative verdict. We will show you exactly how to select between VOO and IVV based on your specific geographic location and choice of brokerage, followed by a step-by-step breakdown of how to buy your first share live. We have stripped down both corporate engines. The math reveals a truth that Wall Street tries to hide with complex marketing. Fundamentally, VOO and IVV are structurally brilliant financial clones. Choosing between them is not a matter of picking a better asset, it is a matter of choosing a financial philosophy that aligns with your identity. If you believe in a system built entirely for consumer utility, where the corporate structure ensures that the interests of the manager are perfectly aligned with the retail investor, Vanguard's VOO is your default choice. You are joining John Bogle's permanent legacy of low-cost, member-owned wealth accumulation. If you prefer a tech-driven titan powered by specialized algorithmic risk management tools like Aladdin, Where sheer scale and institutional liquidity define execution excellence, BlackRock's IVV is your weapon. You are backing the most aggressive and technologically advanced capital network on Earth. However, for investors watching from outside the United States, specifically across the United Kingdom, Europe, or South America, buying U.S. domiciled tickers like VOO or IVV directly can trigger a devastating tax trap: the 30% U.S. withholding tax on dividends and a potential estate tax exposure. To bypass this tax drain, international investors use a specialized financial vehicle, UCITS ETFs domiciled in Ireland. Instead of VOO, they buy Irish domiciled equivalents like VUSA or VUAA from Vanguard, or IUSA from BlackRock. This legal framework slashes the dividend tax burden down to 15% automatically. Now that you have chosen your champion, we must look at the actual terminal. To turn your chosen ticker into a real asset, you must know how to place your first trade without making rookie mistakes that cost immediate capital. We will now walk through the exact mechanics of execution. Your first operational rule for trading is timing. The U.S. stock market opens at 9:30 a.m. and closes at 4 p.m. Eastern Time. As a long-term index investor, you should never place trades during the first 30 minutes or the last 30 minutes of the trading day. This is when high-frequency algorithms create unnecessary volatility. Execute your automated or manual orders between 11 a.m. and 2 p.m. This is the period of peak market liquidity. The bid-ask spread is at its narrowest point, and prices move in a smooth, predictable stream. You are buying your assets at the truest, fairest market value of the day. When you click the trade button inside your brokerage app, you are faced with a choice of input fields. You will see shares or dollars. In 2026, thanks to fractional share technology, you do not need to wait until you have enough cash to buy a full share of VOO. You can type in an exact dollar amount, even just $10. If you are investing a fixed amount of capital every single month as part of your automated baseline plan, a standard market order is your primary tool. It instructs the exchange to fill your order immediately at the best available current price. Within a fraction of a second, your cash converts into productive corporate real estate. The moment the order confirmation screen flashes green, a profound transformation occurs. You are no longer just an economic worker saving paper cash that is rotting against inflation. You are officially a partial owner of Apple's global tech monopoly, Microsoft's cloud infrastructure, and NVIDIA's artificial intelligence factories. The beauty of holding VOO or IVV is that you never have to worry about individual companies failing or going bankrupt over time. The S&P 500 index features an automatic self-healing mechanism. It ruthlessly kicks out declining, poorly managed corporations and replaces them with rising, highly profitable innovators. Look at the history of the index. Decades ago, the S&P 500 was dominated by railroad networks, steel mills, and oil companies. Today, it is led by software giants, semiconductor designers, and digital logistics networks. By owning the index, your capital automatically transitions into the most advanced sectors of human capability without your intervention. Once your trade is complete, your biggest psychological enemy is the urge to check the app every single day. Watching the daily price movements of VOO or IVV is like standing over a freshly planted seed and screaming at it to grow. It accomplishes nothing except inducing cognitive exhaustion and triggering emotional panic. Studies consistently show that the best performing accounts at major brokerages belong to people who either forgot their passwords or have passed away. In the financial markets, inactivity is a highly paid skill. Your wealth is built by the millions of employees working inside those 500 companies, not by you staring at a screen. True investing is meant to be completely boring. It is a utility process. You allocate capital to the global engine of capitalism, you lock the door, and you go back to maximizing your active income and living your life. The market is your leverage system, not a secondary full-time job. Today, we demolished the complexity of the stock market's core index. We analyzed the fee parity, exposed the structural variations between Vanguard's mutual layout and BlackRock's technological trust, and mapped out the exact operational windows you need to use to deploy your funds cleanly. Your immediate task tonight is to log into your selected brokerage account, search for your chosen ticker, whether it is VOO, IVV, or an international equivalent, and look closely at the interface. Familiarize yourself with the layout so that when your monthly automatic deposit clears, you can execute without hesitation. The era of guessing where to put your money is over. You are no longer blind to the inner machinery of Wall Street. You have selected your vehicle, understood its internal safety protocols, and learned how to bypass transaction friction. The engine of your global wealth machine is now running in the background. But building an unshakable compounding engine is only half the battle. If you leave these newly acquired assets exposed inside a standard brokerage account, you are leaving a massive back door wide open. Tomorrow, in Day 7, we introduce the ultimate defensive layer, the tax shield. We will break down the exact legal accounts that prevent the government from stealing your growth. Many beginners stall their execution because they believe they can predict the market cycles. They read headlines claiming a crash is imminent, so they hoard cash, waiting for the perfect bottom. This is a mathematical trap. Decades of market data prove that time in the market always beats timing the market. While you sit on the sidelines waiting for a correction, the underlying companies inside the S&P 500 continue to generate revenue, buy back shares, and distribute dividends. The compounding interest you miss during periods of hesitation creates a permanent deficit in your long-term capital trajectory. The weapon to defeat this paralysis is dollar cost averaging. By investing a fixed amount of money at identical intervals, regardless of whether the index is up, down, or flat, you remove human emotion from the equation entirely. You automate your behavior to exploit market volatility. Look at the mechanics. When the market drops, your fixed dollar amount automatically buys more fractional shares of VOO or IVV at a steep discount. When the market rises, your money buys fewer shares at a premium. Over time, your average cost per share balances out into an ultra-efficient baseline. Financial news networks exist for one reason: to capture your attention and sell advertising. They do this by manufacturing constant states of urgency. If you internalize their panic, you will inevitably commit the cardinal sin of investing, selling your index assets during a temporary market correction. A market correction is not a structural failure, it is a normal macroeconomic breath. Historically, the S&P 500 experiences a 10% pullback roughly once a year, and a 20% bear market every few years. Every single one of these downturns has eventually ended in a new all-time high. When the market declines, the value of your assets shrinks on paper, but the number of shares you own remains exactly the same. You have not lost money unless you click the sell button and lock in those temporary paper losses. The index investor simply treats market dips as a corporate clearance sale. To survive these cycles, you must shift your perspective from a consumer mindset to a generational ownership horizon. You are not trading digital tickers for a quick weekend profit. You are accumulating productive real estate inside the global economic core to fund your life decades from now. The custodian interface you choose to house these assets matters. Modern brokerages in 2026 have eliminated standard trading fees for major index funds. Whether you use institutional legacy houses or agile digital platforms, ensure your broker supports automated recurring deposits and fractional share routing. You do not need a chaotic dashboard filled with 30 different specialized industry ETFs to build wealth. A singular, hyper-focused core holding tracking the S&P 500 contains all the corporate diversification you need to outpace 90% of professional fund managers over a 15-year window. As we approach the execution phase, let this reality settle in. If your capital is sitting in Vanguard's VOO, you are backed by a structure that treats you as an owner. If your capital is in BlackRock's IVV, you are backed by an elite algorithmic infrastructure engineered to win every micro penny of efficiency. There are no bad choices here. The structural debate is resolved. The fee matrix is clear. The operational trading windows have been defined. The only variable remaining in this wealth architecture equation is your willingness to step across the boundary from spectator to active asset allocator. Once you make your first investment and watch the compounding loop begin, a dangerous psychological trap often emerges: the illusion of safety. You see your net worth ticking upward automatically, and you begin to think you are completely immune to economic shocks. Many investors build a beautiful capital engine but completely forget to insulate it from external legal and institutional hazards. They keep their long-term holdings inside standard taxable accounts, leaving their future growth vulnerable to massive tax drags that pull down their terminal wealth velocity. It is not enough to simply buy the right asset, you must hold it inside the right regulatory envelope. If you fail to utilize the legal tax structures provided by your country's financial framework, you are voluntarily sacrificing a massive percentage of your lifetime compound returns back to the state. This brings us to the final, most critical pillar of our 7-day architecture. You have built your active cash flow, secured your operational defense buffer, and selected the absolute safest index vehicles on the planet to anchor your growing capital pool. Now, we must build your fortress. Tomorrow, in the final installment of this series, we break down Day 7, the tax shield and the exit plan. We will dismantle the exact legal accounts that allow your investments to grow completely tax-free, and map out the precise mathematical withdrawal protocol required to live off your dividends forever. The gatekeepers of Wall Street wanted you to believe this arena was reserved for the elite. They wanted you trapped in complex mutual funds and high-fee products. Today, that illusion is dead. You know the tickers, you know the costs, and you know the operational execution blueprint. Open your selected platform tonight. Find VOO or IVV. Internalize the interface layout. The transition from a worker who sells time to an owner who scales assets is entirely operational. Lock in your choices, secure your parameters, and prepare your mindset for the final defensive blueprint. The foundation of your asset machine is set. Now, we shield it from the tax collector. Click the video appearing on your screen right now to enter Day 7 and activate your permanent financial sovereignty. I will see you inside the fortress.